After studying this module, we shall be able to learn the concept of balance scorecard, target costing, know the meaning of Kaizen costing, benchmarking, understand the meaning of life cycle costing, learn the meaning of activity based management and just in time method, commonly known as JIT, elaborate theory of constraints and human resource accounting.
Contemporary issues imply new and strategic issues which suit the needs of today's business with multi-branches and global operations. These are generally known as part of strategic management accounting. According to Cooper and Kaplan, strategic accounting techniques are designed to support the overall competitive strategy of the organization, principally by the power of using information technology to develop more refined product and service costs. A business firm today exists in highly competitive, dynamics and volatile environment and faces very complex managerial problems. The focus, therefore, has now shifted from traditional management accounting techniques to contemporary issues in strategic management accounting. Most of the versatile techniques included in the module have been developed in the USA, UK and Japan as a pathway to progress. These techniques have been advocated for use by managements for combating with the contemporary issues of this era.
The balance scorecard is a strategy performance management tool, a semi-standard structured report supported by design methods and automation tools that can be used by managers to keep track of the execution of activities by the staff within their control and to monitor the consequences arising from these actions. Subsequently, Kaplan and Norton in the late 1990s gave 4 steps to design a balanced scorecard, which are 1. Translating the vision into operational goals, 2. Communicating the vision and link it to individual performance, 3. Business planning, which means index setting, 4. Feedback, learning, and adjusting the strategy accordingly. The balanced scorecard terminology was first coined by A. Skanderman, though Kaplan and Norton are seen as the creators of the concept. Early writings on balanced scorecard by Kaplan and Norton has focused on uses of balanced scorecard rather than its design. Although it helps focus managers' attention on strategic issues and the management of the implementation of strategy, it is important to remember that the balanced scorecard itself has no role in the formation of strategy. In fact, balanced scorecards can coexist with strategic planning systems and other tools. Improved design method. In the mid 1990s, an improved design method emerged. In the new method, measures are selected based on a set of strategic objectives, plotted on a strategic linkage model or strategy map. With this modified approach, the strategic objectives are distributed across the 4 measurement perspectives so as to connect the dots to form a visual presentation of strategy and measures. Characteristics that define a balanced scorecard are: number 1, it focuses on the strategic agenda of the organization concerned. 2, it selects a small number of data items to monitor. 3, it contains a mix of financial and non-financial data items. 4, Balance Scorecard highlights a company's strategy by focusing on cause and effect relationship. It translates the strategy into measurable targets and communicates the same to all members of the entity. In a good balance scorecard, the number of measures are limited as they are restricted to only critical factors. The scorecard highlights suboptimal trade offs that the managers make when they fail to consider operational and financial measures together. Balance scorecard gives emphasis on financial objectives and measures in a profit seeking company. First generation balance scorecard. This generation used the four box approach to assess performance. These perspectives or boxes were typically financial, learning and growth, internal business processes, and customer. The balance scorecard alluded to a relationship between these four perspectives, but the relationship was not often used or seen. The figure depicts that four dimensions taken on the balance scorecard are of opposing nature, and for achieving success in each of these areas, they have to be individually managed so that an optimum balance is reached. To sum up, it is correctly stated by Kaplan and Norton that the balance scorecard provides managers with the instrumentation they need to navigate to future competitive success. Target costing is a pricing method used by companies. It is defined as a cost management tool for reducing the overall cost of a product over its entire life cycle with the help of production, engineering, research, and design. A target cost is the maximum amount of cost that can be incurred on a product, and with it, the firm can still earn the required profit margin from that product at a particular selling price. A comprehensive definition of target costing is: target costing is a disciplined process for determining and achieving a full stream cost at which a proposed product with specified functionality, performance, and quality must be produced in order to generate the desired profitability at the product's anticipated selling price over a specified period of time in the future. In the traditional cost plus pricing method, materials, labor, and overhead costs are measured and a desired profit is added to determine the selling price. Target costing involves setting a target cost by subtracting a desired profit margin from a competitive market price. The four basic steps of target costing are: number 1, define the product; number 2, set the price and cost targets; number 3, achieve the targets; number 4, maintain competitive costs. Kaizen costing. The word Kaizen is a Japanese word meaning continuous improvement. It is a mechanism for managing and reducing costs. Therefore, it will not be wrong to describe it as a cost reduction system. It is important to know the difference between the target costing and Kaizen costing. Target costing is applied during the design stage, whereas Kaizen costing is applied during the manufacturing stage. Therefore, Kaizen costing is applied to products that are already in production phase. Prior to Kaizen costing, when the products are under development stage, target costing is applied. Yoshihiro Morden defines Kaizen costing as the maintenance of present cost levels for products currently being manufactured via systematic efforts to achieve the desired cost level. Morden has described two types of Kaizen costing: asset and organization specific Kaizen costing activities planned according to the exigencies of each deal; product model specific costing activities carried out in special projects with added emphasis on value analysis. Objectives of Kaizen costing. The objective of Kaizen costing is to reduce actual costs of manufacture to below the standard cost. It is a very versatile tool of management which is mostly used in manufacturing organizations. Benchmarking is the process of comparing one's own business processes and performance metrics with best practices from other industries. Dimensions typically measured are quality, time, and cost. In the process of best practice benchmarking, management identifies the best firms in their industry or in another industry where similar processes exist and compares the result and processes of those studied with one's own results and processes. It is also referred to as best practice benchmarking or process benchmarking. It allows organizations to develop plans on how to make improvements or adapt specific best practices, usually with the aim of increasing performance. Benchmarking is often treated as continuous process in which organizations continually seek to improve their practices. The steps in benchmarking are: select subject, define the process, identify potential partners, identify data sources, collect data and select partners, determine the gap, establish process differences, target future performance, communicate, adjust goal, implement, review, and recalibrate. The three main types of costs in benchmarking are: number one, visit costs. This includes hotel rooms, travel costs, meals, a token gift, and lost labor time. 2. Time costs. These include members of the benchmarking team will be investing time in researching problems, finding exceptional companies to study, visits, and implementation. 3. Benchmarking database costs. Organizations that institutionalize benchmarking into their daily procedures find it useful to create and maintain a database of best practices and the companies associated with each best practice. Now, types of benchmarking. Process benchmarking. Here, best processes are identified. Financial benchmarking. It is performing a financial analysis and comparing the results in an effort to assess your overall competitiveness and productivity. Performance benchmarking. It allows the firm to assess their competitive position by comparing products and services with those of target firms. Product benchmarking. It is the process of designing new products or upgrade to current ones. Strategic benchmarking. It involves observing how others compete. Functional benchmarking. A company will focus its benchmarking on a single function to improve the operation of that particular function. Best-in-class benchmarking. This involves studying the leading competitor or the company that best carries out a specific function.
Life cycle costing involves costs associated with the product for its entire life cycle. These costs are commonly referred to as cradle to grave or womb to tomb costs. Costs which are considered include the financial cost, which is relatively simple to calculate, and also the environmental and social costs, which are more difficult to quantify and assign numerical values. Typical areas of expenditure which are included in calculating the whole life cost include planning, design, construction and acquisition, operations, maintenance, renewal, and rehabilitation, depreciation, and cost of finance and replacement or disposal.
Therefore, whole life cost or life cycle cost refers to the total cost of ownership over the life of an asset. Whole life cost analysis is often used for option evaluation when procuring new assets and for decision making to minimize whole life costs throughout the life of an asset. It is also applied to comparisons of actual costs for similar asset types and as feedback into future design and acquisition decisions. The primary benefit of life cycle costing is that the costs which occur after an asset has been constructed or acquired, such as maintenance, operation, disposal, becomes an important consideration in decision making. It also allows an analysis of interrelationships that exist between business functions. For example, low development costs may lead to high maintenance or customer service costs in the future. While making this calculation, the depreciation cost on capital expense would not be included. To sum up, life cycle cost analysis is a tool to determine the most cost effective option among different competing alternatives to do a project when each is equally appropriate to be implemented on technical grounds. Chartered Institute of Management Accountants defines activity based costing as an approach to the costing and monitoring of activities which involve tracing resource consumption and costing final outputs. Resources are assigned to activities and activities to cost objects based on consumption estimates. The latter utilize cost drivers to attach activity costs to outputs. Peter F. Drucker states that traditional cost accounting focuses on what it costs to do something. For example, to cut a screw thread, activity based costing also records cost of not doing, such as the cost of waiting for a needed part. Activity based costing records the costs that traditional cost accounting do not do so. ABC is based on George Stauber's activity costing and input output accounting. The concepts of ABC were developed in the manufacturing sector of the United States during the 1970s and the 1980s. Robin Cooper and Robert S. Kaplan, proponents of the balanced scorecard, brought notice to these concepts in a number of articles published in Harvard Business Review beginning in 1988. Cooper and Kaplan describe ABC as an approach to solve the problems of traditional cost management systems.
Activity based costing, commonly known as ABC, is a costing methodology that identifies activities in an organization and assigns the costs of each activity with resources to all products and services according to the actual consumption by each. This model assigns more indirect costs, which are overheads, into direct costs compared to conventional costing. With the help of ABC, a company can soundly estimate the cost elements of entire products, activities, and services. It helps the company in deciding to identify and eliminate those costs and services which are unprofitable and lower the prices of those that are overpriced. Identify and eliminate production or service processes that are ineffective and allocate processing concepts that lead to the very same product at a better yield.
In a business organization, ABC is generally used as a tool for understanding product and customer cost and profitability based on the production or performing processes. As such, ABC has predominantly been used to support strategic decisions such as pricing, outsourcing, identification, and measurement of process improvement initiatives. Instead of using broad arbitrary percentages to allocate costs, ABC seeks to identify cause and effect relationships to objectively assign costs. Once costs of the activities have been identified, the cost of each activity is attributed to each product to the extent that the product uses the activity. In this way, ABC often identifies area of high overhead costs per unit and so directs attention to finding ways to reduce the costs or to charge more for costly products. The just-in-time, commonly known as JIT, inventory systems focus is having the right material at the right time, at the right place, and in the exact amount, without the safety net of inventory. The JIT system has broad implications for company using it. Just in time is a production strategy that strives to improve a business return on investment by reducing in process inventory and associated carrying costs. If it is implemented correctly, JIT focuses on continuous improvement and can improve a manufacturing organization's return on investment, quality, and efficiency. To achieve continuous improvement, key areas of focus could be flow, employee involvement, and quality. The JIT's basic philosophy is simple, that storage of unused inventory is a waste of resource. The JIT inventory philosophy defines how inventory is viewed and how it relates to management. Objectives of just in time. Number 1, to maintain zero inventory. 2, to ensure on-time deliveries without fail. 3, to bring about a situation of no breakdown. 4, to ensure zero defects. 5, to bring about elimination of non-value added activities. Benefits of JIT. Main benefits of JIT include reduced setup time, the flow of goods from warehouse to shelves improves, it simplifies inventory flow and its management, employees with multiple skills are used more efficiently, production scheduling and work hour consistency synchronized with demand, enhances focus on supplier relationships. It minimizes storage space needed. Last but not the least, there are smaller chances of inventory breaking or expiring. Difficulties of JIT. Just in time is a means to improving performance of the system, but it is not an end. Very low stock levels would imply delivery of the same part several times per day. JIT does not usually have the top level management support.
Before beginning to learn the theory of constraints, we must understand the meaning of constraint. A constraint is anything that prevents the system from achieving its goal. Types of internal constraints are equipment, people, and policy. TOC is based on the principle of limiting factor, which was propounded by Henry Fayol. While elaborating the ways to improve the principles for improving planning processes, TOC focuses on bottlenecks or hindrances so as to improve the performance of the production system as a whole. It aims at short-run maximization of throughput contribution, which is revenue minus material cost.
Objectives of TOC are: number 1, maximizing throughput contribution; 2, minimizing investment and operating costs. Steps under TOC. Number 1, identify the bottleneck and the throughput contribution. 2, find needs of the bottleneck operations and compare with non-bottleneck operations. 3, Increase bottleneck efficiency and capacity. 4. Repeat the process for each bottleneck identified. 5. Decide how to exploit the system's constraint and how to get the most out of the constraint. The three factors of theory of constraints are throughput contribution, investment, and operating costs. To sum up, the theory of constraints is a management paradigm that views any manageable system as being limited in achieving more of its goals by a very small number of constraints. There is always at least one constraint, and TOC uses a focusing process to identify the constraint and restructure the rest of the organization around it. TOC adopts the common idiom, a chain is no stronger than its weakest link. This means that processes, organizations, etc. are vulnerable because the weakest person or part can always damage or break them, or at least adversely affect that outcome. Human resource accounting is the process of identifying and measuring data about human resource and communicating this information to interested parties. Objectives of human resource accounting. Number 1, to furnish cost value information for making proper and effective management decisions. Number 2, to monitor effectively the use of human resource by the management. 3, to have an analysis of the human asset. 4, to aid in the development of management principles and proper decisions for making the future of various practices. Human resource accounting helps the management in employment and utilization of human resources. It helps in deciding transfers, promotions, training, and retrenchment of human resource. It provides a basis for the planning of physical assets vis-à-vis human resources. It helps in evaluating the expenditure incurred for imparting further education and training of employees in terms of the benefits derived by the firm. It helps to identify the causes of high labor turnover at various levels and taking preventive measures to contain it. It helps in locating the real cause for low return on investment, like improper or underutilization of physical assets or human resources or both. It helps in understanding and assessing the inner strength of an organization and helps the management to steer the company well through the most adverse and unfavorable circumstances. It provides valuable information for persons interested in making long term investments in the firm. It helps the employees in improving their performance and bargaining power. It helps each employee understand his contribution towards the betterment of the organization. Limitations of human resource accounting. Number 1, historical costs, resunk costs are irrelevant for decision making. 2, a reasonable value cannot be provided to human resources. Number 3, it capitalizes only the training and development cost and ignores the future cost of maintenance. Lastly, high skilled human resources cannot be properly valued.
Let us now recapitulate what we have learned in this module. Balanced Scorecard provides managers with the instrumentation they need to navigate to future competitive success. Target costing is a pricing method used by companies. It is defined as a cost management tool for reducing the overall cost of a product over its entire life cycle with the help of production, engineering, research and design. The word Kaizen is Japanese word which means continuous improvement. It is a mechanism for managing and reducing costs. Kaizen costing is appropriately described as a cost reduction system. Benchmarking is the process of comparing one's own business processes and performance metrics with best practices from other industries. Dimensions typically measured are quality, time, and cost. Life cycle costing involves cost associated with the product for its entire life cycle. These costs are commonly referred to as cradle to grave or worm to tomb costs. Activity-based costing, which is commonly known as ABC, is a costing methodology that identifies activities in an organization and assigns the costs of each activity with resources to all products and services according to the actual consumption by each. The just-in-time, commonly known as JIT, inventory system focuses having the right material at the right time, at the right place and in exact amount without the safety net of inventory. The theory of constraint develops a specific approach to manage constraints to maximize operating income and continuing improvement. Human resource accounting is the process of identifying and measuring data about human resource and communicating this information to interested parties.